Good evening, everyone. I welcome you all to our live webinar on recent EAC opinions under India's framework. Today, I am myself Secretary Expert Advisory Committee, Parul Gupta, and I have been joined today by our Chairman Expert Advisory Committee and immediate past President, CA Dr. Devashish Mitra ji, who will be here with us in few moments, and CA Piyush Hadarji, who is our Vice Chairman Expert Advisory Committee, and our distinguished speakers for today, Dr. Avinash Chandra ji and CA Vishal Bansal ji, and our moderator for the session, CA Mohit Bhuteria ji. I welcome you all, and now I request CA SM Gupta ji, who is our Technical Director of ICI, to introduce our speakers formally. Thank you.
So thank you, Parul, and good evening, everyone. Before I start introducing the star speaker of the day, I want to give a small background of the Expert Advisory Committee. Our Chairman, sir, will be joining very soon. Welcome, Vice Chairman, sir. I see on the screen. The Expert Advisory Committee was established way back in 1975, almost 48 years now, service to the nation. From the preamble of this committee was to give expert opinion on the various complex accounting issues, whether AS based or India's based. So the manner in which the discussion is done in this committee is fantastic. Sometimes we feel that issue is so simple, it is giving in one direction, right? But the kind of the intensity and the diverse view comes and how the decisions are taken is really, really fantastic in this committee. From 1975, when 75 opinions were issued in this committee, today we are happy to share with you that more than 1600 opinion has been issued by this committee. 1600 opinion, which is there now in 42 compendiums. So we also issue annual or quarterly compendiums. So we have 42 volumes of those compendiums, which is available on public domain. Now, in addition to this, the members can also search our opinion. We have a technology-based platform now, the search engine. The members can, put a keyword or the date of the opinions or the volume of the compendium, and they can extract the real opinion and they can take the guidance from there. So this is the fifth seminar during the current year. The kind of visibility the EAC has got this year, especially under the chairmanship of Dr. Devashish Mitraji and Vice Chairman sir, it is really fantastic. Now, in the today's webinar, we are having two extremely respected, panelists, Dr. Avinash Chandra ji, who is a former technical director of ICI for more than 3 decades. He is holding a vast experience of 5 decades in total. He is at present the member of International Taxonomy Consultative Group. He is also a director of XBRL India, Special Invitee on Expert Advisory Committee, Accounting Standard Board, Committee on Public and Government Financial Management, advisor to the Government Accounting Advisory Board, GAZAB, and many other groups. So it's always been pleasure to listen Dr. Avinash Chandra. Welcome, sir. Welcome to this webinar, sir. Our second panelist for the day is CA Vishal Bansalji. He's an eminent chartered accountant holding close to 25 years of professional experience. He's a partner in a large chartered accountancy firm and leading a technical department of the firm. He holds a diverse and a vast experience on the India's and IFRS matters. He has been currently a special invitee in the expert advisory committee, and he has been contributing incredibly, great in various technical committees and various platforms of ICI. Previously, also he was also associated with various technical directorate initiatives. So, welcome, CA Vishal Bansalji. So, the moderator for the day today, again, very eminent chartered accountant, CA Mohit Bhuteria ji. CA Mohit Bhuteria ji is a managing partner in one of the reputed chartered accountancy firm and having close to 3 decades of experience, vast experience, and he's also holding a huge experience of IFRS, India's insolvency professional. Presently, he's a corporate member of EAC and he's also associated with various other committee of ICI in one capacity or the other. He has been handled more than 1,000 statutory audit, mostly India's base of banks, PSUs, private sector bank, and has given led lot of deliberations on taxation, company law matter, merger and acquisition, restructuring, and non-banking financial assurance issues. So welcome, Mohit Bhuteria ji. I think today's the kind of topic has been selected today. The presentation of trade receivables, accounting treatment of export initiatives, accounting for interest earned on fixed deposit. I think the panel is really nothing better than we can get it. So now with this, I hand over the proceeding to Mohit Bhuteria ji. Mohit Bhuteria ji, from here onward, please take on.
Thank you. Thank you so much, Vice Chairman sir, my co-speaker Avinash ji and Vishal ji, members at office bearers at EAC, Gupta ji, Parul ji, Khushbu ji, Preeti ji. We'll take up, I think we have 5 case studies. I think my screen is visible. Parul ji, screen is visible?
Yes, sir.
Yes, sir.
Yes, yeah. Visible.
Yeah, so we start with the first query. Presentation of trade receivables realized by way of discounting of bills in the financial statements under Ind AS framework. So there is a company which constructs hydropower projects and supplies electricity to state discoms and other bulk power purchasers who are required to settle their dues as per agreed payment plan. In certain cases, there have been delays in settlement of dues by the discoms. To prevent accumulation of dues and to liquidate its trade receivables, the company enters into bill discounting agreements with scheduled commercial banks. As per these agreements, the bills of a DESCOM upon whom invoices for supply of power have been drawn are presented to the bank for release of upfront payment less interest charged by the bank to the company. The amount for which bills have been discounted are repaid to the bank by the DISCOM in 10-12 monthly installments as per the quantum of monthly bills discounted. This arrangement is with recourse to the company, and in case of non-payment by the DISCOM, the bank shall be entitled to recover the unpaid amount along with charges, if any, from the company. The bill discounting charges and any other charges, including penal interest for overdue payment charged by the bank, is refunded by the DISCOM to the company. Trade receivables which have been liquidated by way of bill discounting are presented in the balance sheet as current assets, financial assets, trade receivables, and a corresponding liability towards the bank as current liabilities, financial liabilities, borrowings. The company has been following the above accounting treatment consistently. However, considering that the trade receivable has already been realized in cash once the bill has been discounted, a view has been expressed that the financial asset which has been transferred is no longer in the nature of a trade receivable and rather should be presented as an asset under current assets under financial assets instead of being presented as trade receivables. This is further justified by the fact that as a part of bill discounting documentation, the DISCOM undertakes to comply with all the terms and conditions as are agreed upon between the company and the banker. Accordingly, trade receivables which have been liquidated by way of bill discounting no longer retain the characteristic of a trade receivable and should rather be presented in the financial statement as a receivable under other financial assets. An alternate view was also expressed that since the beneficiaries whose bills are discounted are state discoms and there is a minimal chance of default in payment to bank, trade receivables of the company may be presented net of bill discounted, and the amount of bills discounted for which the bank has recourse to the company in case of default by the DISCOM may be disclosed as a contingent liability. So the query is whether the accounting and presentation of trade receivable which has been liquidated by way of bill discounting as followed by the company is proper, or whether these trade receivables should be reclassified to other financial assets, or whether these trade receivables should be de-recognized and the amount for which the bank has recourse to the company should be disclosed as a contingent liability. So this is the first query. I would like Shri Avinash Chandra to please deliberate on this query.
Thank you very much. And good evening to everyone. As seen from the facts of the case, broadly what has happened in the current scenario is that a company has transferred its trade receivables to a bank, and which it is calling as discounted with the bank because the bank has charged interest thereon. Now, what the company is currently doing, that the company has not de-recognized the trade receivables, which means it is already presenting the trade receivables under the current assets. And as per the requirements of Ind AS 109, they are showing a corresponding borrowings on the liability sides of the balance sheet. So that is the current accounting treatment which the company has done. The question which has been raised by the querist is that whether the current accounting treatment is appropriate or not, or as an alternative from the presentation perspective, while the trade receivables continue to be de-recognized from the balance sheet. Sorry, the trade receivables are not de-recognized from the balance sheet. They continue to be recognized on the balance sheet. But instead of presenting the same as trade receivables, they should be presented as under the head other financial assets and not as trade receivables. That is issue number one. And the second is what the company is proposing, that these trade receivables should be de-recognized and the liability should be considered as a contingent liability. Now, since the accounting for de-recognition of the financial asset, that is the trade receivables is involved in the present case. So therefore, the expert advisory committee at the outset examined whether the de-recognition of the trade receivable should be done or not. So for that purpose, the committee considered the requirements of the Ind AS 109, and the relevant requirements are in paragraph 3.2.3, there is a subparagraph that A, which according to which the financial assets should be de-recognized if the two conditions given in paragraph 3.2.3, either of these two conditions are met. The first is that the contractual rights to cash flows expires. Now, in the current case, they do not expire. So therefore, this particular condition is not relevant. So the second is that whether it transfers the financial asset as per paragraph 3.2.4 and 3.2.5. And if there is a transfer, then the second condition is that the transfer qualifies for de-recognition as per paragraph 3.2.6. So since in the current case, the company has transferred the trade receivables to the bank, so it meets the requirements of paragraph 3.2.4 because the cash flows from the trade receivables get transferred to the bank. So it is a case of a transfer of financial asset as such. Then the committee examined whether this particular transfer, whether it qualifies for de-recognition or not. So for the purposes of de-recognition, it considered the requirement of paragraph 3.2.6, according to which if the entity transfers substantially all the risks and rewards of ownership, then the concerned financial asset should be de-recognized. Now, in the current case, as it has been pointed out in the facts of the case, the bank has full recourse to the company. That is, in the event in which the payee does not make payment to the bank, in that case, the bank can take a recourse to the company and it can recover the amount which has been disbursed to the company, including the interest, and not only the interest, any bill discounting charges, any penal interest for any overdue payment. So in other words, keeping in view the fact that there is a full recourse of all the amounts involved in this particular case, the committee concluded that the entity has not transferred substantially all the risks and rewards of ownership. So therefore, the derecognition of the trade receivables is not warranted. So accordingly, the committee opined that the trade receivables should be continued to be recognized, keeping in view the requirement of paragraph 3.2.15 of Ind AS 109. And I will read out the wording because that is very important from the perspective of the decision which the committee has taken. The wording is that if derecognition criteria are not met, then one, the company should continue to recognize the transferred asset. The focus is on to continue to recognize the transferred assets. Now, in this particular case, the transferred asset is trade receivables. So therefore, the committee opined that the transferred asset being trade receivables, it should be continued to be recognized and correspondingly recognize a financial liability for the consideration received, which the company is already doing, that it is already presenting this as a borrowing, I mean the amount received as a borrowing. So therefore, recognition of the amount received as a borrowing is not a question involved in this particular case. Now, with regard to the alternative proposal, which the company has specified as per the facts of the case, the argument which the company is giving and which has been read out in the facts of the case, that the nature of trade receivables has changed after discounting because the company has received cash, and therefore it should not be presented as trade receivable but as another asset, some other financial asset under the head other financial assets. So the committee did not agree with this alternative view because, as I read out, as per the requirements of paragraph 3.2.15, the company should continue to recognize the transferred asset, and the transferred asset in this particular case is the trade receivables. So according to the company, according to the committee, even if the company has received cash, but keeping in view the characteristics or the characteristics of the transactions involved, whereby what has actually happened is that, in fact, keeping in view the fact that there is a full recourse to the company as far as the bank is concerned, the transferred asset should continue to be recognized on the balance sheet of the company as trade receivables and not under the head any other financial asset. And since the derecognition requirements are not met, so the question which the querist has raised, that is an alternative view, that derecognize and show the amount received as contingent liability, that question does not arise because the derecognition requirements have not met, and therefore as per the requirements of the Ind AS 109, it has to be recognized, continue to be recognized as trade receivable with a corresponding financial liability as such. So it cannot be shown as a contingent liability if you want to derecognize the trade receivables, because derecognition requirements of Ind AS 109 have not been met. So the answer of the committee in this particular case was no. In other words, in nutshell, what the committee decided, that what the company is presently doing, that is presenting the trade receivables as a financial asset, that it continues to do so, with a corresponding financial liability. The current practice should continue. So overall, that was the view of the committee. So the committee did not agree with the alternative proposals which were made by the querist. Thank you very much.
Yeah. So very lucid presentation and very lucid, crystal clear answer. Chalji, would you like to supplement here anything?
I think Mahiti Avinaji has very well explained in quite a detail. So not much to add. I think only one or two points I would like to share. I think on a general, this derecognition of financial asset or trade receivable is quite a complex and detailed evaluation exercise to be done. And I think again, the standard lays down very clear and a stringent requirement. So I think whenever that question comes, members obviously need to be, or the companies need to be very careful in evaluation. And I think here one of the point which company was making is that the receivables are from Discom, and or the querist has made are from Discom, and there is a very minimal risk. Hence, it could be shown as contingent liability. Now, on the contrary, in this case, the standard what it requires is that you have to really see how much risk and rewards have been retained versus how much risk really exists on the receivable. So, because the risk itself is very low and you have retained that entire risk, the standard clearly requires that, as rightly as pointed out by EAC, that you have retained all the risks which were existing, and hence receivables could not be recognized. So overall, one has to really evaluate very carefully, in terms of derecognition, and as pointed out by EAC, that retention of risks, even if they are very small, requires you to continue to recognize. So that's point number one. And another point I think Querist was also making, that while it's not very clearly stated that if derecognition is not met, can I present on a net basis? Now that also the standard is quite crystal clear that if the derecognition is not met, you can't achieve similar results through net presentation. You have to show asset or a liability on a gross basis. And I think third point, as Avinaji has already pointed out, that liability which comes, in this case, the question was not raised, and EAC has also not pointed out, but normally it is presented as a borrowing. And fourth point will be that besides these things, and again, not querist as raised, in addition to this presentation, IFRS 7 or Ind AS 107 also contains specific disclosure requirements relating to transfer of financial assets. So those should also be taken care of. This kind of. Thank you.
Okay.
That's it.
So netting is permissible. Netting can be done only if it is expressly permitted by the standard, which was not there in this case.
Right. In fact, in this case, it is specifically prohibited because you have failed derecognition test. You can't do it.
Sure. So we go to our next query. And this is a query regarding accounting treatment
Mohit sir, Chairman sir has joined us.
Sure.
So I request Chairman Expert Advisory Committee and our immediate past President, CA Dr. Debashish Mitra ji, to say a few words and give an overview of our Expert Advisory Committee.
Sure. Yeah. Good evening, Chairman sir.
Okay, all right. So see, sorry, I was in a separate meeting of the, we are having this blowback on the global branding. To all of us who are present here, a very, very warm welcome. I can see Mohit Bhutoria and Vishalji on the screen. Let me tell you, today we had a meeting of the Expert Advisory Committee from 11 o'clock. I think we see 3 or 4 opinions we finalized. You see, sometimes Avinash ji is here with me, and what is very unique to the Expert Advisory Committee is that the kind of issues that it tackles, very, very difficult issues, very, very intricate issues. And let me tell you, the Expert Advisory Committee tries its best to give opinion on various matters. Right? So you see, it tries its best to give its opinion on various matters, sticks its neck out and do the needful on this. So these kind of programs that you are having, the outreach programs that you are having, it is basically to propagate not only the activities of the Expert Advisory Committee, but also the opinions that the Expert Advisory Committee has taken on various accounting issues. Today in the morning when we were there, see, the intricate issues relating to India's was being discussed. And let me tell you, the debate and discussion was so intense that sometimes I, as the chairman of the expert advisory committee, finds it very difficult to come to a conclusion. So all of us who are present here, see, take full advantage of this program that we are having. And you see, at the expert advisory committee, we'll do everything possible to see that the best that is there on by way of technical knowledge is provided to all of you. I wish all of you a very, very happy learning. All the very best. Please continue. Please continue, Mohit. Thank you.
Thank you. So the query is regarding accounting treatment of export incentives. So the facts are as follows. The company is engaged in the business of engineering consultancy, construction of projects, export of rolling stocks, etc. After getting the export order from clients, the company enters into a back-to-back agreement with Indian Railways production units for manufacturing of rolling stock oblique locomotives as per drawings and specifications approved by the client. Once the rolling stock or locomotives are ready by production units, these are dispatched in compliance with the terms and conditions of the respective agreement with the clients. The company is getting incentives on export under foreign trade policy of the Government of India, read with remission of duties and taxes on exported products notified by the Ministry of Finance. The company is receiving following two types of export incentives. The first one is incentive by way of duty credit scripts under RODTEP scheme. Prior to 1st October 2021, this was known as Merchandise Exports from India scheme. Now, the facts of this scheme are these duty scripts are due at the time of realization of foreign currency against the export through in RODTP scheme. Prior realization of foreign currency is not mandated, and duty credit scripts are allowed against the presentation of shipping bill or bill of export, but subject to realization within the stipulated period as per FEMA, failing which the script shall be deemed to be ineligible. The value of incentive varies from 1.5 to 2% of FOB value depending upon the harmonized system of nomenclature code under which export material is covered. Duty credit skips can be used by the company for payment of import duty, or it is also tradable in the market value, which varies from 80 to 95% of value of scripts depending upon the demand and supply of duty credit scripts in the market. Income is booked on receipt of duty credit scripts based on estimated market value, which varies from 80 to 95% of value of duty credit scripts. The second is the duty drawback incentive. In this scheme, the company gets cash incentive, which varies from 1.5 to 2% of the FOB value, depending upon the HSN code under which exported material is covered. Duty drawback scheme is due at the time of export of goods, and the amount of eligible duty drawback is endorsed by the customs authority on the shipping bill. Revenue on account of duty drawback as export incentive is being recognized at the time of export. The company is treating both the export incentives as government grants related to income and is presenting the same as other operating income, since export incentive is directly linked with the revenue from operations of the company. The query for under consideration put forward to EAC is as under: whether incentive or duty drawback as per FTPE read with RODTEP as briefed above falls within the definition of government grant or assistance, thereby attracting the disclosure requirements of Ind AS 20 as required in paragraph 19, including all methods of presentation. Whether the disclosure of export incentive stroke government grant as other operating income is not contravening para 29 of Ind AS, which requires government grants to be shown under general heading such as other income. So these are the two queries for consideration. May I request Mr. Vishal Bansal to kindly deliberate upon the query?
Yeah, sure. So basically, if I really look at it in this case, the company is making into the various kind of business, but one of the business of the company involves export. And for making that export, the company is getting two export incentives. One is RODTEP scheme, which basically gives you again 1.5 to 2% of the scrips, which against the to the FOB value of export. Now, these scrips either can be used to make duty-free import, or it could even be sold in the market. And in case of market sale, there could be some discount to the cash. And second is duty drawback scheme, where you make the export and you get in form of a duty drawback, and you can practically import it by without paying the duty, or you get the refund of duty. Now, in this both the cases, the company is currently eh, treating this as an government grant related to income, and showing this grant as an other operating income. In this case, the auditors have raised certain queries, particularly relating to disclosure and whether this grant should be presented it as an other income or other operating income. Now, I think there are certain other aspects also which are not getting challenged. Now, the querist in this case, particularly if I really look at it, have asked the two major questions. One is whether it's a government grant or it is a government assistance. And I think the major difference on this is that if it is a government assistance, then there is no specific accounting. It is only a disclosure requirement. But if it is a government grant, then it's accounted for as per the requirements of Ind AS 20. So that is one question. And the second major question is relating to the presentation, whether it should be presented as other income or other operating income. And I think that's another important question, which obviously arises in this case, and it's relevant in many other issues also relating to the government grant, which arises the practice. And third was a limited question around disclosure and how much to be made. Now, if I look at in this case, the first question of and if I look at it, government grant accounting, or there are multiple stages to it. The first stage to decide is whether it's a government assistance or a government grant. Now, this then that was the question raised by the query. On this, if I read the guidance or the definition which is there in the standard, it says and I think it's better to read it for the proper understanding. Government grants are assistance. Again, government grants are also assistance by the government in form of transfer of resources to an entity in return for past or future compliance with certain conditions relating to the operating activities of the entity. They exclude those form of government assistance which cannot have reasonably have a value placed upon them, and the transactions with the government which cannot be distinguished from the normal trading transactions of the entity. So this is the definition of government grant and how to differentiate it from government assistance. Then the standard also clarifies, and which is also pointed out by the EAC, the manner in which grant is received does not affect the accounting method to be adopted with regard to the grant. Now, the grant could be received either in cash or it could be in the form of a liability. So if one was to look at this definition and decide whether it's a government grant or a government assistance, I think there, in this case, though, government may not be paying directly a cash, but there is clearly a remission of duty-related liability for conditions relating to export or export and import. So that definition is clearly met. And also there is clearly a value placed in terms of 1.5 to 2% of the FO value of exports, and it is not just normal trading transactions with the government. So considering this, the EAC has concluded that this is a government grant. It cannot be treated as government assistance only. Okay, now, so this was the first question, and this is the first stage evaluation which arises. The second stage evaluation which normally arises is whether it's a grant relating to the asset or a grant relating to income, because the standard differentiates accounting for both. In case of a asset related grant, it gets either net from the asset value or it's matched with the depreciation. In case of a revenue, it's matched with the other expenses which the grant is relating to compensate. Now, in this case, the query has not raised this question. They, I think, were saying that it's anyways, because ultimately you are making export and getting grant for the export. So it's an income grant. Now, EAC has not independently examined, but I think the assumption is that whatever, and EAC has not opined on it, but since Querist has not raised, but Querist is treating it as an income-related grant, and EAC has not independently examined this question. Then third question normally arises in a grant evaluation is that even it is an income-related grant, then you have to match it to the period or with the expenses which the grant is required to or intended to compensate. Now, again, the querist has not raised this question, and they are treating this grant as income as and when they are making export or as and when they get the duty scripts. So EAC has not again examined this question and has not really opined on it. Now, the fourth question which was raised by the querist and is relating to the presentation. If you treat it as an income grant, then how should really be treated? Now, as per the standard, an income-related grant either could be net from the expense or it could be treated as an under the appropriate income head, such as other incomes. Now, those are broadly the words used, and I think it's important to really look at keep those words in mind under an appropriate head, such as other income. That's broadly the words used. Now, in this case, again, querist is not doing net from expense, and if I share my general experience, it's very difficult to specifically pinpoint a particular expense which the grant is intended to compensate. That's why normally people don't do it, netting it from expense in practice, and that's what even querist is doing, and they have not raised it. Now, question is, if you are doing other income or income, then is it to be presented it as an other income, or it could also be the other operating income? Now, in that context, I think the EAC has looked at Schedule 3 guidance, which gives broadly three heads in terms of income revenue from operations, so which is more of a revenue as per IFRS India's 115, which it doesn't fall in. Other operating revenue and other income. And other operating revenue, while I can go through detail, but it broadly talks about it, the activities which are relating to main or principal revenue generating activities. And like a company is doing trading goods and then there is a real estate division. So that could be a other operating revenue. And in this case also EAC has looked at the purpose of the scheme to encourage export and compliance with related conditions. And also as per the standard, there could have been potentially an option to net from expenses if those could be identified, and presumably those are relating to operating expense. So considering all of those things, the EAC has said that it looks like more relating to the operating activities. And if one was to read this requirement along with the Schedule 3 guidance note on Schedule 3 and the standard, India's 20 does not say other income only. It gives a kind of a saying that appropriate heading such as other income. The EC has concluded that it may not be inappropriate or to present it as an other operating income, or in other words, it could be one could look at it presenting it as an other operating revenue. And I think obviously then EAC has said there are specific disclosure requirements of India's 20, one has to really meet it. I think that's broadly the thought process which has gone into this EAC opinion. Now, only one thing probably which, when it comes to the disclosure, may become relevant is now what is important material disclosure. In fact, in the current year, there is a standard on this new amendment onto India's 1 and 8 has also come, which focuses on making only material disclosure, that there should not be a disclosure overload. So one may potentially going forward look at whether those disclosures are really material or not. But yes, if those are material, then disclosures have to be definitely made. So I think this was broadly the opinion, I think.
Yeah, thank you so much. So Avinash ji, you have to add anything here in this query?
Yeah, not much, but I would only like to emphasize a couple of things. One is that, as Vishalji rightly mentioned, that it is the standard requires that it should be shown as an under the head other income. Okay. So this standard does not go into the question of whether it is other operating income. So that aspect of other operating income has been introduced by our Schedule 3 to the Companies Act. So in other words, the requirements of the standard do not go into the question of whether it is other operating revenue or not. And of course, the expert advisory committee has a point that, as Vishalji was putting it, that it would not be inappropriate to present as other operating income. So therefore, it seems that what EAC is saying that okay, you can show it as other operating income, but if you have shown it, of course, for example, tomorrow another company says that I will like to show it under other income and not as other operating income, other operating revenue, then whether that presentation would be incorrect. That if I want to show it in accordance with the requirements of the standard only under the head other income, whether that would not be correct. So, I mean, I am giving just my view that since there would be a compliance with the standard that the company would be showing under other income. So if that presentation is also made, that would also be appropriate, because the EAC is saying that it would not be inappropriate if you show it under other operating revenue. So I thought I will just highlight this point, which is there under the standard, but not. I mean, the standard does not go into the question of whether it is the other operating revenue. And of course, those of you who have been keeping track of what the International Accounting Standard Board is doing, they are coming out with a new standard which will replace Ind AS 1 presentation, and it will be performance measurement standard, performance presentation of performance of the company, where they will make a distinction between the operating revenue, the investing income, the operating income, the investing income, and then the financing income, etc. So when that standard comes in, then even the standard would then require that the items which are related to the revenue, they would be presented with the operating revenue as such. But of course, that is a future thing. I just thought to mention that we may like to keep track of what may happen in future. Thank you very much.
Thank you so much, Avinashji. So before we go to the next question, Avinashji, there was a question relating to our first issue, relating to presentation of trade receivables. Queries has raised that in the facts of that case, since trade receivables are to be shown under as financial assets and financial liability, the amount what has been received, nothing is required to be shown in contingent liability. Is that correct?
Yeah, quite right. Nothing is to be shown because the entire amount has been shown as a financial liability itself on the balance sheet. So there is no amount needs to be shown off the balance sheet, that is as a contingent liability.
Okay, perfect, perfect. So now we move on to our next query. This is relating to accounting for interest income earned on fixed deposits made out of qualified institutional placement. Yeah. So the facts of the case are as follows. The company is a vertically integrated copper producing company. The company mobilized 500 crores equivalent to 4.52% of the existing share capital of the company through QIP in April 21 for funding the ongoing first phase of mine expansion plan. After deducting the issue expenses, including fees and commission of approximately 4.46 crores net of GST, the net proceeds of the issue was approximately 495.54 crores. The company intends to use the net proceeds of the QIP issue towards partial funding of the proposed capital expenditure and expansion of the company. In the QIP placement document, it was mentioned that pending utilization for the purposes, the company intended to temporarily invest net proceed in creditworthy instruments, including money market, debt mutual funds, and deposits with banks and intercorporate loans. However, QIP placement document does not specifically mention about the accounting treatment of interest income from investment of unutilized QIP proceeds. As on 31st March 22, the company has utilized 133.50 crores towards capex and expansion of the company in line with the QIP placement document, and the balance QIP fund of rupees 366.50 crores is lying in fixed deposits in the bank account of the company. The company is earning interest on fixed deposits and accounting for the same as other income in the statement of profit and loss. During financial year 21-22, the company has earned income of rupees 12.86 crores towards interest from fixed deposits, and the same was considered as other income. The auditor observed that expenses incurred in connection with QIP proceeds were treated as capital expenditure, while revenue earned was treated as other income. This mismatch was violating the basic principle of matching concept. The expenditure incurred in connection with issue of QIP is required to be adjusted with the interest income, and the balance amount should be transferred to specific reserve, considering an earlier EAC opinion where EAC had opined that the company should transfer interest to a specific reserve fund with necessary disclosure in the financial statements. So following are the queries which were considered by EAC. First, whether the company is correct in accounting for interest earned on FDs made out of the unutilized QIP funds as interest income of the company by crediting it to the statement of profit and loss account of the company, as there is no specific reference in Ind AS and no specific instruction in QIP placement document for accounting of interest income. Second, whether the company has to create a specific reserve as pointed out by the auditor in respect of the interest earned on the balanced QIP fund. Third, whether the QIP expenses are adjustable from the interest income as commented by the auditor, despite matter being clearly stated in QIP document under chapter use of proceeds that there are no restrictions for utilization of interest income. Fourth, whether the interest income earned on fixed deposit from the QIP proceeds shall be taken to other income or it will be adjusted against CWIP of the above project. And last, what accounting entries should the company adopt for the interest income earned on fixed deposit from unutilized QIP proceeds? So we have 5 queries to deliberate upon, and may I request again Avinash ji to take up this query.
Thank you very much. Now, in this particular case, what has happened is that there is a QIP, the qualified investment has taken place, and the primary objective of this issue is that the proceeds will be used for the capex, that is for capital expansion. However, pending the incurrence of the capital expenditure, these funds which have been received through this QIP, they have been temporarily invested in the fixed deposits. So the question is that the income, that is the interest received on the fixed deposit, whether it should be recognized as interest income under other income in the statement of profit and loss, or this interest income, since it is related to the capex, because the QIP was made for with the objective of capex, whether this interest income should be adjusted against the expenditure which would be incurred on the capex. So that was the first question. So for this purpose, the expert advisory committee considered paragraph 21 of Ind AS 16 on property, plant and equipment. I will try to read out that paragraph and then try to relate it with the facts of the case and then the ultimate opinion which the committee has given. So the paragraph says that some operations occur in connection with the construction or development of an item of property, plant and equipment but are not necessary to bring the item to the location and condition necessary for it to be capable of operating in the manner intended by the management. Then it goes on to state these incidental operations may occur before or during the construction or development activities. Then the paragraph gives the example of a car park. That is for a building site, some land is acquired for a building site, and pending the construction of the building, it is let out as a car park, and from that car park there is an income. So this paragraph then goes on to say that this income, even though these operations may be incidental, but this income is not considered to be related to the manner intended by the management, and therefore it should be recognized in the statement of profit and loss. Now, in the current scenario also, the QIP funds have been invested in FDs. Pending utilization, these may be considered as incidental activity because the purpose of raising funds was to be used for the capital expenditure purposes. So therefore, this may be considered as incidental activity. However, the committee then went into the question of the first part of the requirement under paragraph 21, that whether these are necessary to bring the item to the location and condition necessary for it to be capable of operating in the manner intended by the management. The committee concluded that the income from the FDs is not necessary to bring the item to the location and condition necessary for it to be capable of operating in the manner intended by the management. Because without this income also, the expenditure would have to be incurred to be brought. I mean, the expenditure have to be incurred, and this income is not necessary that this should be considered as item, I mean, which is necessary to bring the item into location and condition. So that condition is not met, and therefore it is not to be considered as for the purposes of capitalization, as was, auditor was specifying, but the company is rightly showing it as other income. Now, of course, this particular treatment is also supported by paragraph 35 of Ind AS 32 of Ind AS 32, which relates to financial instruments on presentation. So paragraph 35 says that if there is an interest income on any financial instrument, that should be recognized in profit and loss. So in this particular case, the FD is a financial instrument, and it meets the definition of financial instrument, and the interest which is earned should be recognized in the statement of profit and loss. So another count also, this treatment made by the company is appropriate. Then the next question which the querist had raised was whether the QIP issue expenses should be adjusted against the aforesaid interest income. That is the interest income against the fixed deposits. So in order to look into the treatment of the share issue expenses, that is, or the QIP issue expenses, the committee looked at paragraph 37 of Ind AS 32, and I will just read out the relevant portion, not the entire paragraph, which says that the transaction costs of an equity transaction, because the QIP was an equity instrument, the transaction cost of an equity transaction are accounted for as a deduction from equity to the extent they are incremental cost directly attributable to the equity transaction, that otherwise would have been avoided. Now, the committee stated that these QIP expenses, these QIP issue expenses, they appear to be the transaction cost, and therefore these should be deducted from the equity, and then they should be disclosed as per the requirements of Ind AS 1 presentation of financial statements. In other words, the committee opined that these share issue expenses cannot be adjusted against the said interest income, that is the interest income which has been earned on the FD, or the project cost. Or, I mean, the auditor was saying they should be adjusted against the project cost, but that would not be appropriate. The third issue which was raised was the presentation of this interest income. Now, having decided first that it should be recognized on the statement of profit and loss, the question was that how it should be presented in the statement of profit and loss. For this purpose, the committee noted the requirements of Note 5 of the general instructions for preparation of profit and loss of Division 2 of Schedule 3, which was relevant to the company in question, and which stated that under the head other income shall be classified as interest, dividend, etc. So in other words, the Schedule 3 states that other income should be classified in, if there is any interest income, it should be shown under the head other income. The committee also noted the similar requirements of, given in the guidance note on the subject issued by the Institute of Chartered Accountants of India, which also recommends that this interest income should be reflected under the head other income. And another question which was raised was that whether the interest income which is earned on the fixed deposit, whether it should be transferred to any special reserve. Now, actually, this question rose from an earlier opinion of the expert advisory committee, which has been referred in the facts of the case also, where as per the relevant terms of the contract or the agreement which the company has entered into, there was a specific requirement that any interest income earned on the investments, it should be transferred to a special reserve. I mean, there was a specific requirement under the terms of the agreement itself. So that is the reason here also this question is raised, that whether in this case also it should be transferred to any special reserve. Now, in this context, the committee noted that in the current scenario, there is no specific requirement under the terms of the agreement of the issuance of the QIP about the treatment of the interest income. So therefore, it should not be transferred to a special reserve. The requirements of the Ind AS as well as Schedule 3 to the Companies Act should be followed, and it should be reflected under the head other income in the statement of profit and loss. So that is how all these questions were answered. And I think this gives rise to another point which I would like to highlight, that all the opinions should be read in the context of the facts of the case itself. So it is not necessary that the opinion which is given by the expert advisory committee, every opinion will apply in all facts and circumstances. For example, this special reserve situation is not relevant in this particular case. It could have been relevant under some other situation. So implementation of the opinion, from implementation of the opinion perspective, that is very important to understand under which facts and circumstances that opinion was given. So that needs to be noted. Thank you very much.
Thank you, Avinashji. So very important key takeaway. As you said, each opinion has to be considered in the light of its own facts and circumstances. So Vishalji, would you like to add here anything?
I think Avinash has very well explained, Mohitji.
Yeah.
Probably one or two points which is very important. I think, see, ultimately, probably as an auditor, we were thinking that if it is funds are raised for, let's say, a capital project, any interest income earned out will be also be capitalized. But I think India 16 has brought out a very important aspect that only the expenses or the income which are required and which are directly or attributable to the construction are to be capitalized. There could be other incidental activities happening, like I have raised funds, I don't need it immediately, and it's earning income, but it doesn't directly add value to the project or direct. So that's where it can't be capitalized. I think the principles have to be looked at it in that light. That is one. Second, I think another thing which Querist was doing was, in this case, they were capitalizing this QIP expenses. Probably they have incurred some 5.71 crore QIP expense, out of which 4.21 crore was capitalized under CWIP. Now, I think again, this raising of funds is not something which is directly attributable. You need funds, but that's more of an incidental activity. That's where EAC has said that these cannot be capitalized, but these have to be treated as a transaction cost, which gets deducted from equity. Now, obviously, I think neither the querist is clarified nor the EAC has dwelled into what happened to remaining 1.5 crore, whether those are gone into equity or those have been charged off to P&L. But I think generally, as a matter of principle, when you are doing any kind of IP or QIP expenses, it's also important that the transaction costs only which are incremental or directly attributable, those gets capitalized. But there are in this kind of activities, there could be certain other activities like you are doing road shows and which are more like an advertisement and other things. Those are not directly relating to the share issue, nor they add a value to any CWIP. Those will have to be capitalized. So as a matter of when we are doing these aspects in practice, one will have to really look at it, how the expenses which can be adjusted from the equity are appropriately identified and determined, considering the principles which Avinash was also highlighting in the transaction cost definition. So I think that was only two points to be added from my side.
Okay, thank you very much, Vinashji. Now we come to the next query. Yeah. So this is a case of treatment of expenses incurred for construction of high-speed rail project by the company under the Ind AS framework. So coming to the facts of the case, the company is incorporated to build a high-speed rail project between two states. The company is engaged in one and only activity, that is creation of self-constructed asset. The project includes activities from acquisition of land, earthwork, laying tracks, station building, signaling and telecommunication, overhead electric, bridge, tunnels, station, etc. The company has incurred expenditure on spectrum charges, project promotion expenses, and research and development expenditure during the project. Now, coming to the spectrum charges, the project being high-speed project requires high-speed communication along with the track. In order to provide connectivity, dedicated frequencies required to be obtained by the company for use in the company's radio equipment. The wireless users are required to pay spectrum charges to Wireless Planning Commission for use of allocated spectrum. Spectrum charges include license fee and royalty. Frequencies were obtained on advice and instructions of Messrs. J, who is assisting in detailed designs and overall project scheduling work for the project. Mr. J has informed that the company is required to ensure availability of frequencies for train radio systems during design stage, since the selection of frequencies will have a considerable impact on the design of the systems, including arrangement of repeaters, etc. And it is important that the frequencies are allocated at this time so as to avoid any delay on the system design and overall project schedule. If the availability of these frequencies is not ensured for the project, all these indicated systems will need to be redesigned. The radio system is critical for running of high-speed trains. If there is any change in the design of the radio system, it will not be proven for high-speed railway and will also be costly and time-taking. As per letter issued by WPC, in case period of validity of requested license is more than 1 year, the maximum period being 5 years, amount may be paid in advance for the entire period of license or annual installments in advance. As the amount paid remains the same, either the company pays annually or for 5 years. The company in this case decided to pay annually. These spectrum charges are recurrent charges and will be payable as long as the spectrum is kept by the company. If the spectrum charges are not paid, the earlier payments made by the company cannot be recovered from WPC as these frequencies have been secured for the company. Therefore, the company cannot suspend the payment of spectrum charges. Based on the above, the company has concluded that spectrum charges are necessarily required to be incurred during construction of the project for design work. Accordingly, these payments are treated as CWIP since the project is under construction. The project promotion expenses comprised mainly of the following: expenses towards display of Syncastion simulator model in exhibition, sponsorship for various events, social media team expenses. Simulator was imported for display of simulator model of bullet train during various exhibitions. Sponsorship expenses represent expenditure for sponsoring events wherein the project can be displayed. Social media expenses are majorly related to handling social media, short film documentary for the project, etc. The project is one of the unique projects of the Government of India, and in order to execute the project, stakeholders consultations have been conducted at various stages and concerns of these stakeholders have been addressed. Various stakeholders not only include the government ministries and the regulatory authorities, but also the project affected persons due to land acquisition. All the important processes, including development and implementation of traffic diversion plans, removal of encroachments, land acquisition, implementing innovative sources of financing, require public awareness and consultation, beside engagement and consultation with different agencies and stakeholders involved in the process. Since these activities are essential for seamless and timely completion of project and the company is in the construction stage, these expenditure were capitalized. Now coming to the research and development expenditure, the project is one of a kind and the first bullet train project in India. In order to understand the technology and alternative methods to be used for construction of the project, need for specific researches were felt. Accordingly, a trust was incorporated in the name of H Innovation Center. This trust works with various IITs for understanding and developing different alternatives for construction of the project. Accordingly, payments made to HIC are treated as capital WIP pending capitalization of the asset, that is the project. The query for consideration are whether accounting treatment of expenditure of spectrum charges, project promotion expenses, and research and development expenditure which are incurred for the project by the company is correct. If not, what should be the alternative treatment as per applicable Ind AS? Is there any different accounting treatment as compared to the treatment done by the company in financial statements? Are these changes will be treated as changes in estimate, accounting policy, or prior period errors? So this is the case. Now may I request Vishalji
Right. So
kindly deliberate.
right. So I think again, just to very quickly reiterate the facts which we are dealing with it. I think that what the company is doing is they're developing a high-speed rail project, which is one of its kind. And though obviously the company will incur various kinds of expenses for the project, but now in this case there are the three expenses which are getting discussed. One is what is the spectrum charges. Now the spectrum is something which is required. Now, this is a high-speed metro project, and there is end-to-end connectivity between the railways. So for that connectivity and connection, you need this spectrum and related communication devices. But I think in this case, the peculiarity is that this communication channel or the spectrum need to be identified upfront, and there has to be and it is required to have a proper smooth designing of the plant itself or the train itself. It's not that you need only for an operational purpose. That is one premise, one expense. Second is the company is doing various kinds of so-called promotional expenses, which include event sponsor, highlighting the project at various conferences and social media activities. And I think also the queries has somewhere pointed out that it is also required to identify and address the concerns of various stakeholders and so on overall promotional expenses. And third, this project being unique, there is a various kinds of research and the development activities which really need to do to get a new knowledge, to develop new technology, etc., etc. So these are broadly the three expense which the querist is currently capitalizing it, and they have really asked that whether this accounting treatment is currently right or it needs to be treated differently. And if differently, then what happens to the past accounting treatment? I think obviously it's a very long and a unique project and the unique query also in that sense. And I think if I really read this query, to me it looks like a kind of a master class on capitalization principles, and very important and very critical principles which are highlighted. If one has to really read and understand some of the capitalization principles, this is a really a good opinion, very good opinion of the EAC, and I think to me it looks like a master class on capitalization principles. So and so that I think is the kind of opinions which get issued in and some of them are really stands out. Now, in this case, I think the first point, which obviously we chartered accountants and the management is well aware, but I think EAC has very well highlighted and articulated at the outset itself that it says that the committee wishes to point it out that various expenses are incurred during the construction period. However, it is not necessary that all the expenses incurred during the construction period are capitalizable. And I think it has also further gone ahead and stated that it is possible that at that stage during the construction period, the company is doing only and only the activity of constructing a project or two projects. But it still doesn't mean that 100% of the expenses will get capitalized. You will still have to apply the principles of NDS 16 and NDS 38 to identify the expenses which are capitalizable and the expenses which are not capitalizable. And obviously, the expenses which cannot be capitalized have to be charged off to P&L. Now, this is an extremely important principle which is there and which has to be, I think, applied. Now, you can no longer afford that we are not preparing a P&L during the construction period. So that's one wonderful principle which EAC has highlighted. Now, second, if I look at it in the spectrum charges, probably the aspect which was playing in this case was, I think, firstly, before getting into the spectrum charges, the EAC has stated that like you are paying, there is a 5-year license, you are getting 5-year license, which is like a non-cancelable thing. You have to pay it, or even if you cancel, your whole thing goes. Now you can pay entire amount upfront, or you can pay it over 5-year period. Now currently the company is treating it as a period cost, 1-year payment, and treated in that first year, either capitalized or expense. Now, EAC looked at it whether this is really a period cost or it needs to be 5-year capitalized upfront and depreciated or amortized. Now, in that case, I think the company is getting the license for that 5-year period, and EAC has looked at it from the definition of an intangible asset. There is a resource which the company is controlling, and it's the payments are more like a deferred payment. So I think the EAC has said that this spectrum cannot be treated as a period cost. It is an intangible asset to be recognized upfront for the 5 years obviously there will be a discounting of 5-year payment, and that intangible asset is recognized upfront instead of treating it as a period cost. That's another important principle brought out, that if there is a right which meets the definition of an intangible asset, it has to be recognized as intangible asset. One cannot treat it as period cost. That was the another important principle, which could be, now in this case it's a spectrum license, but one has to look at it. Can there be a right in other cases? And I think, just as a matter of question, as Avinash and Mohit has already highlighted, the EAC opinions may not apply in other cases, but yes, when you are looking at it, the principles, you will have to still look at your specific facts and evaluate whether there could be an intangible asset which need to be recognized. Then next question, I think, was around capitalization. And here the question was that, see, when you are developing a project, the company starts incurring various kinds of costs to ensure smooth operation once the construction is completed. Like if you need the employees, the company starts recruiting those employees upfront. You can't recruit all the employees on the day of opening of the store. Now, those employees are not really required to run the store till the time it is operational. Now, if you have recruited them earlier, can you capitalize it? There, because you are just appointing those employees in advance of the operation, they don't contribute to the construction, so that cannot be capitalized. Now, in this case, also probably there was a concern that, is this really contributing the value add to the project, or it is more of that as soon as the plant is ready or the train is ready, you need the spectrum and you have got it upfront and you are incurring an upfront expense which is not contributing. I think that was probably the principle, and I think there, which is more of a technical matter and or a matter which through the consultant and the other aspects, which EAC has looked at it and said that this is not really the so. Actually, to design what kind of design is required, how it will really work, do you need the spectrum upfront? Now, if the kind of spectrum you get it could actually make significant changes in the design, and entire construction is also happening around that design. If there is a change in the spectrum, the entire design could change. So that to start designing the plant itself, or to start designing the asset itself, the asset is required. It's not just ensuring the smooth operation. So that's where these are the assets which is required to get into the construction. Without this, the construction cannot take place. And consequently, while spectrum is treated as a intangible and amortized, but that amortization is contributing to my construction of the entire this high-speed rail project, and I could capitalize that amortization as part of the cost of the asset. So I think that's another important principle, and I think it's very important distinguishing and feature which EAC has brought out in this thing, in terms of having incurring expenses in advance to get to the smooth operation versus the expenses which are required to undertake and complete the construction itself. Now, third question was around promotional expenses. I obviously see the standard and the other, even India's 16 and India's 38 are clear. You can't capitalize the advertisement expenses. Now, here the querist has tried to highlight various kinds of expenses, but broadly it's like sponsoring the seminars, increasing awareness about these projects, probably informing and educating to the various stakeholders. So I think the EAC has looked at it, and based on the understanding that these are the expenses which are to more advertise or more bring aware the public about the initiatives being taken, they are not directly contributing to the construction, or they are not helping in terms of taking this project forward, but more public awareness kind of thing through social media activities, and they do not add value to the construction. Consequently, they cannot be capitalized. They have to be charged to the profit and loss as and when they are incurred. So another important principle. And then finally, on the research and development, I think the querist was saying, oh, it is incurred in connection with the overall construction of the project. So I just capitalize it. I think there EAC has brought out that for the intangible asset, for any kind of a new knowledge, one can't just go based on India's 16 principles. One has to look at India's 38, where it is very clear that the research phase activities are very uncertain. You don't know what is going to happen. Even if you are doing research for a construction of fixed asset, you don't know whether that will really help or not. consequently, any research expense has to be charged off to the P&L as and when it is incurred. And when it comes to development expenses, again, there are India's 38 lays down various criteria in terms of technical feasibility, future economic benefits, my commitment to undertake those developments, gain those knowledge, use, etc., etc. So the company has to establish and estimate the cost. Only when then you can really say that these new kind of innovations which you are doing will add either directly or to the my project. And once those criteria are met, then only you can start capitalizing it. Otherwise, it's more like trying to do certain activities which may or may not get to any benefit, and consequently, you cannot be capitalized. I think again a very important principle brought out and re-emphasized by the EAC. So I think very important principles to my mind, which EAC has highlighted in with regard to the capitalization. And I think finally, then obviously the question is that whatever EAC has said, be it spectrum charges being recognized as period cost versus intangible asset, or that's expenses relating to promotional or research and development, seems like what is required by the standards and articulated by the EAC was not getting followed on the ground by the company. Now, and because those principles were not followed, that's an error, and it needs to be treated as an error only. It is not a new standard which EAC has said, one could say change in an accounting policy or an estimate. So that's where EAC has said that since it is the principles were not applied appropriately as they should have been, it is an error, and that error has to be corrected as per India's aid. I think very important principles which EAC has overall highlighted in this. So
Yeah.
that's
Yeah, very correctly pointed out. This was one of the most critical opinions, and I remember this was deliberated by all of us at length, and it gives a lot of guiding principles in relation to capitalization, which one can obviously use for cases. May not be similar to this case, but principles have been laid, and as you were saying, not all expenditure incurred during capitalization during the period of construction stands to be need be capitalized. You gave the example of the employees also, that you may have recruited employees, but you may have incurred cost on research, but all those costs need not go into capitalization. So, Avinash ji, you have something to add on this?
I don't have anything specific to add, except I would like to re-emphasize what Vishalji pointed out at the outset. As the first principle, as he mentioned, I would like to re-emphasize that, because many times it is commonly understood that if a company is under a construction stage, then all expenditure incurred during the construction stage is to be capitalized. It is a very common. I have heard many professionals to argue that I am in a construction stage, so whatever expenditure I am incurring, it has to be capitalized. But as Vishalji pointed out, and the EAC has opined, that you have to, it is not all expenditure which you can blindly capitalize. You have to examine each and every individual expenditure, look at the nature of the expenditure, and then decide, keeping in view the requirements of Ind AS 38 as well as Ind AS 16, to what extent these expenditures can be capitalized. So I thought I would re-emphasize this point, because this is a very common argument which I hear, that if a company is under a construction stage, then everything needs to be capitalized. It is not so as such. So I will only focus on that. Thank you.
Yeah. So before we go to the next query, Avinash ji, there is a query relating to the third case under consideration. The query is asking whether we net off interest on temporary fund invested in fixed deposit for borrowing cost for capitalization of interest as per Ind AS 23 borrowing cost. So I think in the case under construction, there was no borrowing cost. So had there been borrowing cost, that would be netted off. If you can kindly throw some light on this.
Yeah, you are right. Actually, Ind AS 23 is a specific standard on borrowing costs, as you have rightly pointed out. And the principle enunciated there is that if there are borrowing costs, let us say there is an interest expense on some borrowings, and then that particular borrowing is not used for capital expenditure purposes, but if it is temporarily invested, then any income from that interest, that investment is adjusted against that interest expense. Now, in this particular case, it is not a case of a borrowing, it is a QIP, which is an equity instrument. And therefore, the question of any corresponding interest expense does not arise. And that is the reason the committee did not get into the question of Ind AS 23 at all. So the principles of Ind AS 16, paragraph 21, and those principles were examined and then applied, that this interest income is not to be treated as part of the project cost or to be adjusted against the project cost as such. So that is the reason, because here there is no question of any borrowing cost involved in this particular case.
Yeah.
Thank you.
Yeah. So we go to the next query. This relates to a recognition of interest on mobilization advance against project contracts under Ind AS framework. So the facts of the case are as follows. The company is engaged in mining of bauxite, manufacturing of alumina and aluminium, in pursuit of increasing the capacity of its alumina refinery from 2.275 metric ton per year to 3.275 metric ton per year of alumina. The company has undertaken major expansion project of a sum of 6,321.20 crores. The expenditure incurred so far for the project has been fully funded from surplus cash reserve or internally generated funds of the company. The company has not borrowed any fund for financing the project. The company has awarded various project contracts for execution of the project, and in order to quick start up of the project, there is an optional clause for availing interest-bearing mobilization advance up to 15% of the contract value. Some vendors have opted for mobilization advance, and the company is recovering interest from vendors running bills against supply of goods and services. The interest recovered and accrued on mobilization as advance is recognized as interest income of the company and credited to the statement of profit and loss. The auditors of the company are of the view that interest recovered and accrued on mobilization advance should be adjusted against the cost of the project rather than recognizing as interest income, as the same is inextricably linked to the construction and acquisition of fixed asset and is a direct nexus to the project. As per the company, it is financing its expansion project from its own cash reserves created out of profit accrued during earlier years. Generally, such cash reserve is invested in the form of fixed deposit, mutual funds, and income from these are credited to the statement of profit and loss. Mobilization advance is being paid to the contractors out of such cash reserves by liquidating the investment in bank mutual funds as and when required. It is only a change in pattern of investment. The investment base is changed from bank deposits or mutual funds to a contractor in the form of interest-bearing mobilization advance. By giving the advance, there is a sacrifice of interest income on the surplus funds. Hence, the earning of interest income on advance to contractors have been treated as interest income and credited to the statement of profit and loss account. The query under consideration was whether the interest earned on mobilization advance funded from internal cash reserve is required to be adjusted against the project cost, or the existing practice of the company to recognize such interest as interest income in the statement of profit and loss can be continued. So again, this is a very important principle laying opinion. So may I request Vishalji to please deliberate on this issue?
Yeah. So Mohitji, as you have rightly pointed, this is a very important query. Now, in this case, if I really try to understand that the company has on internally generated funds which are invested in banks, etc. Now, the company is expanding its plant or a refinery, and on that they have appointed various kinds of contractors and who are doing the contract work. In this case, obviously, the contractor has two options broadly, what I could understand from the fact. Option number one is that you do the work, you get paid for it, and that's it. The second option with the vendor is that, okay, you may need money. You take advance up to the 15% of the contract value from me. And because I am giving you an advance, so I will recover an interest on that, which will be adjusted against your future bills as and when they become really due. And consequently, some of the vendors have gone with option one, and some of the vendors have gone with the option two, and they have taken advance, and on which the company is paying, they are recovering the interest. Now, in this case, the company is recognizing this interest which they are recovering from the vendors as an interest income. And I think if I really look at it, the auditors have a concern is practically, if I have to really look at it, that what is happening is that I'm paying money to the suppliers. Let's say I'm paying 100 and I'm recovering back 10 as an interest. So should my project cost really be a 90, or it should really be 110 as an income? So they have not really put it in these many words. One could have really looked at it in that sense, that what should really be my, is that really an income, or it's my effectively a reduction to the project cost? And I think that's where this query is coming up. And if I really look at it, probably this facts in some cases could really be judgmental. But based on these facts of this query, what I could understand is that when it's not that they're recovering interest from all the vendors, or all the vendors are taking advances, but rather it's a vendor choice to take advance and pay interest. Now, in this case, what the EC has looked at it is that there are two transactions which are happening. The vendors are taking advance from me, on which they are paying interest, which is more indirectly like giving up of a loan or a financing transaction. And second is they are obviously getting paid on an arm's length basis for their contracts. And I think if I look at it in that case, while there could be a link, but these are the two transactions in the one single transaction. I think that's where one has to look at it. And in that context, if I really look at it, the EAC has looked at the principles which is laid down in India 16. And I think I would really like to read that paragraph once again for the benefit. Some operations occur in connection with the construction or development of an item of property, plant, and equipment, but are not necessary to bring the item to the location and condition necessary for it to be capable of operating in the manner intended by management. Now, these incidental operations may occur before or during the construction or development activities. For example, income may be earned through using a building site as a car park until construction starts. Because incidental operations are not necessary to bring an item to the location and condition necessary for it to be capable of operating in the manner intended by the management, the income and related expenses of incidental operation are recognized in profit or loss, and included in the respective classification of income and expense. Now, in this case, if what the EAC has looked at it is that this interest income which is arising is more of an incidental this thing. Okay, it's more to fund and give finance. It is not directly contributing to the construction of or expansion of project. Now, even if those are, it's more to fund and smoothen those operations, and interest is earned in a kind of a separate transaction. So one can't really say that these are the expenses which are required to bring the asset to its present location and condition. So that's point number one. Secondly, obviously, like we were debating in an earlier EAC opinion also, that the company is doing this entire funding out of its own funds. There is no borrowing cost, which one could say that if there was a borrowing cost, this could be netted it off from the borrowing cost. In fact, because there is no borrowing cost, India's 23 principles do not come into picture at all. So that was another thing. And I think another argument and another twist, which one was to give it to this EAC opinion, could be, let's say, if the company was giving this interest-free advances and not charging interest, one could have also looked at it that because you are paying significant advances upfront, is there a consequential reduction in the construction prices? And indirectly, you are financing, which is a separate, and that financing element may also require to be separated. Now, that principle is not directly articulated in India 16, particularly on advance side, but it is definitely on deferred payment side. Like if you are making a deferred payment, you discount and you recognize that uh, discounted amount at this thing. Now, one could say it's a reverse principle. If there was no interest, that you are actually funding your vendors and you are not earning interest. If that was the case, so in this case, there is a separate financing element which is getting into it. So in that kind of a scenario, and if I look at or the EAC looked at all of these aspects, and they said that because in this case there is a funding happening, that funding is more of an incidental operations. It is not necessary to bring the asset to present location and condition. There is no borrowing cost, which is required to this thing. So consequently, all of those things allude or indicate toward that there is no interest income which could be capitalized. Rather, it could be treated. It has to be treated separately. And in fact, probably it was a reverse situation that there was an advance, but no interest. One could have said that is there a reduction in the fixed asset value or project cost due to advance, because you are indirectly reducing your cost through advance. So that aspect also could have been requiring to separation of interest income. But having said one, if I am as an auditor or as a fact pattern, one should also be mindful that if interest is, let's say, very high as compared to the market rate, so is there a tendency to increase my P&L and consequently production cost? Let's say if the interest income was 20% per annum, and whereas the market rate is only 8-10%. So there could also be an element that it's not actually a financing, but you are trying to jack up your P&L and the balance sheet on both the sides. So those kind of scenarios. But in this case, again, EAC has not gone into this thing. But overall, the thing is that there is a separate financing on which there is an interest income earned, which is on incidental operation. And looking at those incidental operations, the interest income is earned, and that's not relating to construction. It should be recognized as income. So I think that's the aspect which EAC has highlighted in this case. And again, a very important principle, Mohitji.
So what you mean to say that it is almost at par with you have given mobilization advance, you are charging interest. Alternatively, you have put the money in FD, you are getting interest. So in this case, since there is no element of borrowing, both have to be treated at par. Correct?
Yes, absolutely.
Yeah. And accordingly, this interest income would be credited to profit and loss account.
Right.
And as one more principle which you said, that this is from own funds, not borrowed funds. So assuming those funds were borrowed in this case, then what would have happened?
Then, Mohitji, one could have also looked at India's 23, that if there is a borrowing cost and there is an interest income, then is it like an investment of those funds? And consequently, it should be netted it off from the borrowing cost to be capitalized. So if I have to really look at it simply, let's say you have a 100 million limit from the bank. You need only 10 million. You should have ideally drawn 10 million, and that 10 million should have got capitalized. Now, what you did, you withdrawn 50 million. 10 million you used it, and 40 million you put it in a bank account. So practically your utilization at this stage is only 10 million. So since you are capitalizing 50 million borrowing, you are also consequently netting off 40 million interest income on this scenario.
Okay. So you see, what we're finding, all our issues, what we can, even the third query which Avinashji was deliberating on, this interest on FD, again, the similar point, and last query also what we were deliberating on the spectrum charges, again, very principle based. And as Avinashji was saying, not all expenditure or not all income which is earned during the construction period can be capitalized with the cost of the assets or deducted from the project cost. So Avinashji, on this query, would you like to add something more?
I have a very general point to add. Actually, in all opinions which are issued by the expert advisory committee, there is one paragraph at the beginning from where the opinion of the committee starts, because there is C, points considered by the committee, and immediately under that heading there is one paragraph where the committee tries to lay down the scope of the query. So in other words, the EAC then disclaims that some of the aspects which might have arisen in the facts of the case, but which are not part of the query, they have not been considered by the committee. So why I'm raising this point is that because it is important to read that paragraph in order to understand the scope of the opinion of the expert advisory committee. Otherwise, it may be interpreted that whatever else is stated in the facts of the case is correct. So that is not so. What the committee does is that it limits itself to the exact query which is raised by the querist. So the query may be limited to some of the aspects or one of the aspects, while the facts of the case may contain many other situations also. So therefore, it is important to note what is the exact scope of the opinion. And then the committee also lays down certain presumption under which that opinion has been given by the committee. For instance, in the current query, there is a sentence I will read out, which says that it is presumed from the. Sorry?
Yeah, no, please go ahead.
It is presumed from the facts of the case that as per the contractual terms and conditions, the interest earned on mobilization advances is not receivable in cash. Now, why this? A question may arise that why the committee has made this presumption. So here the understanding could be that if the interest, etc., and even the mobilization advance is recoverable in cash, it is receivable in cash, then it would meet the definition of a financial instrument. And then the committee may have to look into the requirements of Ind AS 109, etc., and the other relevant aspects. Now, through this sentence, the committee has made this presumption, which means that this interest and the advance, this advance would not be receivable in cash, but it could be adjusted against the project cost or something. So that is the reason. So that is the reason the committee has only examined paragraph 21 of Ind AS 16, which the committee which Vishalji has highlighted, and on the basis of which this opinion has been given. So I thought that I would highlight that when going through an opinion, it is not only the facts of the case that are relevant, but also the disclaimers and the presumptions which the committee has made. So if those presumptions are not met, the opinion could be different. So therefore, while implementing or while using an opinion of the expert advisory committee, it is important that these aspects are also looked into. Thank you very much.
Yeah, very critical point brought about by you, Avinash. So, Vishalji, we have a query we're addressing. You are saying that the spectrum. Now, the querist is asking whether these spectrum charges would not have been required for the design of the project, but would only have been required for the operation of the project. So then what happens whether these are required to be capitalized or expensed. So I again repeat, what if these expenses are not required for design of the project, but only required for operation of project and acquired in advance, and to what extent these are to be capitalized or expensed?
Interesting question. So if I really, let's go back to India's 16 principles, but basic to analyze it in more detail. Also, India's 16, the expenses which are getting capitalized are the costs of bringing the asset, which are required to bring the asset to its present location and condition. And if I really talk about some of the costs which could be capitalized, like purchase price, net of refundable taxes, any cost directly attributable to bringing the asset to present location and condition, initial estimate of dismantling, etc., which is not relevant in this case. Then some of the examples of directly attributable costs are like costs of employee benefits arising directly from construction or acquisition of asset, cost of site preparation, initial delivery and handling costs of the plant and machinery, installation and assembly costs, and then cost of testing, etc. And then it also standard specifically lays down certain costs which cannot be capitalized. I will emphasize which cannot be capitalized, like cost of opening a new facility, cost of introducing a new product or service, cost of conducting a business in a new location or with a new class of customer, admin and general overhead costs, etc. So I think if I really try to see that now in this case, the revised fact pattern, what I understand is that you don't need these costs to be incurred to bring the asset to its present location and condition. You could have designed, you could have constructed the whole lane, and you actually need this. If I really understood the 24 to run this train, you can't get the spectrum on that day only, and you can start running. You will have to start preparing in upfront. Either it will be delay or you will start preparing few months at the time. The company has gone ahead and taken that spectrum in advance. Okay, now in the how much advance could be management's own judgment and how much extra cost they are really willing to incur. But because it's not required to design or construct the asset, it's more of a preparation for running the new facility. It's more like a cost of opening a facility or cost of serving the new class of customers and so on, which do not directly contribute to this thing. So I think though, again, one may have to look at the specific facts in more detail, but if these were more of just to prepare to run the asset in advance and you are started incurring those costs, it may not be eligible for capitalization. Rather, it may have to be charged to the P&L as and when incurred.
Yeah, very good. So with this, we conclude our deliberation on case studies, and we must compliment, all of us must compliment. Yeah, please, sir.
Yeah, actually, Vishal has very lucidly explained. I would also like to add another scenario to this, which may be probably relevant in the context of the case. That, in this particular scenario, the spectrum license has been obtained for having a life of 5 years. The payment is made for 5 years, and as Vishalji explained earlier, this will have to be treated as an intangible asset. And it was also mentioned in the facts of the case that this would be used in the design of the project. Otherwise, the train will not run efficiently. Now, this is a frequency. Actually, this amount spectrum advance has been paid because it will be used for radio frequency, which will be used during operation stage also. Now, what may happen in this particular case is that, let us say, just hypothetically, let us say that the design of the engine, etc., whatever is the equipment for which it is to be used, as mentioned in the facts of the case, that is used in 1 year, and the remaining 4 years it is used for operation. Okay. So therefore, in what will happen is, as it has been mentioned in the facts of the opinion, that if the design is complete in 1 year, then to that extent, the amortized cost of that intangible asset would be added in the design cost or would be capitalized. The remaining, which is not used for design cost, but is used for running the train, that is for 4 years, the amortization of these 4 years, that will go to P&L. So therefore, one will have to look into the extent to which the a particular asset, it happens in case of depreciation also. Some machine is used for construction purposes and then it is used for operation purposes also. So we capitalize the depreciation expense only to the extent of the machine used for the construction activity. And the later on, after the commencement of commercial production, the depreciation on the same machine is to be debited to the profit and loss account. In the same way here, the amortized cost, to the extent it is used for the purpose of design of the asset, that will be capitalized, and the remaining, if it is used for the operating purposes, to that extent it will be charged to the statement of profit and loss. So there could be, different scenarios under which we may have to take a decision. Thank you.
Yeah. Thank you. Thank you, Avinashji. May I now hand over the proceedings to Vice Chairman, sir?
Thank you. Thank you very much, Mohitji, for a wonderful moderation. My thanks to Avinashji and Vishalji also. Dear all participants, a very good evening to all of you. I think so all will agree that it was a wonderful session and wonderful discussion on very important topics. Most important part of this type of webinars, which I also feel, is that when you read this opinions, you may not get such clarity. Which actually, when you hear the experts, that what was the thought process behind developing these opinions. If my only request to the participants would be that if you have read this opinion earlier, and if you read after this seminar again, if you read this opinion, I think so a lot of doubts would be cleared, because actual thought process which has gone into this opinions really is coming out of such seminars. And really appreciable from both the speakers, Avinaji and Vishalji. They have given their great perspective about the opinion, which has clarified all the doubts about it. Because sometimes I also feel when we read an expert advisory opinion, though now I am part of the committee, earlier I never used to be, Moiji. But when you used to read an opinion, you used to always feel what would be a thought process, because you may not agree with the, obviously you have to follow being a regulatory opinion, but you may not agree with the content of the same. But after listening to such opinions, you feel, yes, your confidence in that opinion, and you tend to agree with what has come. And therefore, it's a very wonderful session. In fact, idea behind such webinars is this only, that all the participants are able to apply. The exact facts, exact topics, or the exact standards may not be applied by all the participants in their day-to-day audit functions possibly. But what happens is, after listening to such webinars, they actually know what is the thought process behind it. So even if the accounting standard is different or the facts are different, they know what is the rationale, the way in which the standards were developed, and how they should apply to it. So thank you very much. I would request all the participants to please keep watch on this. We'll be coming with further opinions for the discussion. This year we have done a lot of seminars on that, and I'm sure all the participants have benefited. My special thanks to Avinash Chandarji, the senior members, who has been always available for the EAC, is part of the committee, and he deliberates each and every tooth and nail. He reads each and every expert advisory opinion threadbare, and he is always available for such seminars. Similarly, Vishalji, thank you very much. Your participants in such a seminars, and the committee is always appreciable. We thank you. EAC committee is thankful to you. Mohitji, thank you very much for spending your time moderating such a wonderful speakers, and moderating it very well for the benefits of all the members. Thank you very much. I would also thank the office for conducting such seminars, and thank you all the participants. Very good evening and good night to you. Thank you. I would request that, thank you, sir. Thank you. I would request the team.
Sir, you are on mute. Piyushji.
Thank you. Thank you.
Thank you.
Parulji, you can end the session.
Tech
you.
support team, can you please
Yeah.
end the session?